All right, y'all. Good morning. This is Khalid Nathan Aleem, the real estate boy, and welcome to Mornings with Khalid. Today, we're going to be talking about where the housing market is going in 2022, as told by 7 leading forecast models. Okay, everybody, as a real estate agent, they always ask me, "Where's the real estate? How's the real estate market?" Or what do you think is going to happen in 2022? So, Fortune just put out an article about the housing market, and again, the title of this article is Where the Housing Market is Going in 2022, as told by 7 leading forecast models. So I'm going to be going over this article and I'll be giving you my expert opinion on this article. All right. So let's start. So the author says a perfect storm. That's the best way to describe the red hot housing market we've seen from coast to coast during the pandemic. It was spurred by a combination of recession induced low mortgage rates, remote work allowing buyers to sprawl further away from their workplace, and a demographic wave of first-time millennial home buyers entering into the market. All right. Of course, years of underbuilding means there simply aren't enough homes available to meet the demand. Cue record price growth. All right. So in this first paragraph, what they're saying here is that there are a couple of reasons why we're having the red hot housing market. Number one is low interest rates because of the pandemic. We had the pandemic. They wanted to keep a kind of a cap on things, so they kept the mortgage rates low. Okay. Then also because people were allowed to work from home, a lot of people moved closer to their families and friends. So bunch of us were allowed to a bunch of everybody were allowed to move were allowed to work at home, so they moved closer, so that made people move. And also you had a bunch of first time millennial home buyers entering the buying market, and then years of not building enough homes. All right, so that's what this first paragraph is saying. It continues, but how much longer will this run? After all, home price appreciation of 19.9%, a 12-month record set between August 20th and August 2021, can't be sustained forever. And that's correct. So from August of 2020 to August in 2021, what they're saying is that the average home appreciated close to 20%, which is phenomenal. So if you own real estate in this last year, from last August to this August, you really should have seen an uptick as far as your appreciation. I know I have. Okay. One of my properties went up 100%. So, I mean, of course, the housing market is just crazy. Okay. But let's continue on. So the article continues to say, already there are signs the housing boom is losing some steam. We're seeing seasonally a cooling off period that happens like clockwork most years. Return to the market after it was absent during the holiday and vacation stretch last year. That's not all. More home buyers are finally beginning to push back against surging prices. Indeed, in October, 60.3% of homes involved a bidding war, which is down from an all-time high in April of 74.5%. There's also the increased likelihood the Federal Reserve will rise rates to tap down inflation. Rising mortgage rates could price out some buyers altogether. All right. So in here, what it's saying is that the housing market is losing steam, and that happens. And as it says in this paragraph, like clockwork, you have usually the spring season, and then you have the summertime, and then at the end of the summer, people stop focusing really on buying homes, and people going back to school, the weather changing. There's a lot of things that happen. Okay, that affect people, okay, maybe not buying homes at the same clip they were doing in the spring and the summer. So last year during this time, remember, we were in the pandemic. So because a lot of people took their homes off the market, there was such short supply. So last year, this time, it was super, super duper red hot. Okay. But things have cooled down. There's more houses on the market, even though there's still a dearth of homes out there and people are still getting top dollar for their homes. There's more homes on the market today than it was last year this same time. So the market has cooled down a little. It's even saying here in October, 60%, which is a lot, 60% of sales were in bidding wars, okay, versus April where it was 74. That's almost two-thirds. Two-thirds of homes were in April, two-thirds of homes were in bidding wars, where in October it was 60%. So in this article, it's just saying there's a likelihood also that the Fed is going to raise the rates because inflation is crazy. Inflation is straight out of control. I mean, have you guys gone to the gas pump? You going to the gas pump and you sitting there and you got to make a life decision like, am I going to get gas or am I going to eat today? Now, for a lot of y'all, it's not that serious, but you be thinking there. I mean, I got an SUV. And my SUV, if I was bone dry on Easy E, if I was bone dry on We Want Easy, it would be like $40 to fill my tank up. Now it's like $70. Now it's like $70. Now when my wife goes shopping, because she usually does the grocery shopping, and she comes back, I mean, I've probably seen like a 20 or 30% bump in prices. So inflation is getting everybody out here. Inflation is catching everybody out here. So what this is saying is that the Federal Reserve, what they'll probably do is they'll probably raise the interest rates a little bit because it's getting out of hand. And also the mortgage rates are trying to come up also, even though historically, all right, historically, if you look over the past 50 or 60 years, historically, mortgage rates are still at an all-time low, but they are creeping up. They're definitely creeping up. Okay, let's continue. The article continues to say, what does this mean for home price growth in 2022? And that's why we're here. Okay, what are these? Where's the housing market going in 2022? Because we're almost there. Man, this year has went super fast, right? Where is the housing market going in 2022? Okay. And what Fortune did is they gathered seven leading forecast models, and they're going to tell you what they're saying. And then I'm going to give you my chime in on what I think of it. Okay. So what does this mean for the home price growth in 2022? To find out, Fortune reviewed 7 industry forecast models, but buyers and sellers alike won't get much peace of mind from these forecasts. The economic models don't produce anything close to a consensus. Some of these forecast models predict price growth next year will go down as one of the highest on record. Others are forecasting a rate of appreciation that will be the slowest in more than a decade. So they're on these forecasts that they got. They're on each side, and that happens most of the time because we don't know what's going to happen in the future. We don't know. Okay, but they have these forecast models, and what Fortune is saying, we took 7 of them. We got some on this side, and we got some on that side. Okay, sorry, y'all. Let's break it down. So it said, let's take a look at these models and also look why there's so much uncertainty heading in the next year. All right. So on the high end of the spectrum are Zillow and Goldman Sachs. Okay. So again, on the high end of the spectrum are Zillow and Goldman Sachs. Zillow projects home prices will rise 13.6% between October 2021 and October 2022. Meanwhile, Goldman Sachs forecasts a 16% uptick between October 21 and December 22. Okay. For perspective, the largest 12-month uptick in the lead up to the 2008 housing crash was 14%, 14.1%. Simply put, researchers at Zillow and Goldman Sachs are priced out, see priced out buyers falling further behind next year. So Zillow in the next year, because we're in November right now, Zillow predicts that home prices are going to go up 13.6% in from this October till next October. Okay, this is what Zillow is predicting. Now, what Goldman Sachs is predicting is that it's going to go up 60%. Now, before the 2008 crash, it went up 14.1%. Okay, that was the highest, 14.1%. But Goldman Sachs is predicting that we're going to go up 16% in the next year, which is crazy. Okay, so anyway, let's see why Goldman Sachs says that. Goldman Sachs said the supply and demand picture that has been the basis for our call for a multi-year boom in home prices remains intact. All of the shortages affecting the U.S. economy, the housing shortage might last the longest. Okay, might last the longest. So this is what Goldman Sachs is saying. All right, so let's see what the rest of them say. What's going on here? Well, neither Zillow nor Goldman Sachs forecast the demographic wave of first-time millennium home buyers letting up. We're in the midst of the 5-year period between 2019 and 2023 in which the 5 largest millennium birth years between 1989 and 1993 are hitting the all-important first-time home buying age of 30. According to their forecast, there won't be enough homes to satisfy all the demand next year. So what does this mean? So what they're saying is, what Fortune is saying is that Goldman Sachs or Zillow, they're not taking into account that you have a millennium class who was born from 1989 to 1993, okay? From 2019 to 2023, they become 30. And they're saying that's the time when people usually buy their first home at 30, okay? So at the end of the day, what are they saying? They're saying that there won't be enough homes. There just won't be enough homes. And if you look at the oldie but goodie supply demand curve, if the supply is down, the demand will go up. All right, so that's what they're saying. All right, let's move on. All right, so since 1980, Fortune calculates home prices on average have climbed 4.6% per year. Over the past year, price growth 19.9% is 4 times that level. So what Fortune here is pointing out is that from 1980 till now, homes have climbed on average 4.6%. But over the past year, it went 19.9%. That's 4 times the level. Meaning what? That this real estate right now is bananas. Straight bananas, okay? So let's move on. Let's move on with the article. The article says the good news is the good news for would-be home buyers. All right. So what's the good news for would-be home buyers? Among the 7 forecast model Fortune examined, 4 predict we'll see growth in 2022 fall back closer to historical averages. All right. So that's the good news. The good news for those who are looking to buy a home is that out of the 7 forecast models that Fortune examined, 4 of them said that we're going to go back to closer to historical averages. Okay. That includes Fannie Mae and Freddie Mac, which are predicting U.S. home growth of 7.9% and 7%. Now, that's slightly higher than the historical norm. However, it's hardly the eye-popping numbers we've seen during the pandemic. Meanwhile, models released by Redfin and CoreLogic foresee 12-month price growth falling to 3% and 1.9%. Can't talk. 9.1% respectively. All right. So these are the other four. All right. So Fannie Mae and Freddie Mac. All right. They see the home growth, the home price growth for the next year around 7-8%. All right. And Redfin and CoreLogic for the next 12 months, they see home price growth 3 to 1.9%. So between 2 to 3%. All right. So what is that saying? They're all over the place. All right. It depends on who you riding with. Are you riding with Redfin and CoreLogic, who are saying that price growth over the next year is going to be 2 to 3%? Or are you riding with Fannie Mae or Freddie Mac, who are saying that the price growth for the next year is going to be between 7 and 8%? Or are you riding with Zillow and Goldman Sachs, who are saying that price growth over the next year is going to be anywhere between 14 and 16%? Put in the chat who you riding with. All right, right now, put in the comments who you riding with. You riding with Goldman Sachs and Zillow, or you riding with Freddie Mac and Freddie Mac, Fannie Mae and Freddie Mac, or are you riding with who was next one? Redfin and CoreLogic. Also, give me a like. Hit the like button for the algorithm, please. Hit the like button for the algorithm and share this out. Share this out to a couple of people because they probably want to know too what's going to happen in 2022. All right. So let's move on. So the article says, what do the models predicting substantial price deceleration have in common? They foresee price growth getting chopped down by raising mortgage rates. Okay. So you have Zillow and Goldman Sachs again, who's saying 14 price growth over the next year is going to go to 14 to 16%. But these other ones like Freddie Mac and Redfin and CoreLogic, why are they a little bit more conservative? Because what they see is that mortgage rates are going to rise. So the article says, as of Monday, the average 30-year fixed mortgage rate stands at just 3.1%. By the end of 2022, Fannie Mae projects it hit 3.4%, while Redfin model says 3.6%. All right. Those jumps are bigger than they may appear. All right. So what they're doing right now is they're breaking down, okay, why is Fannie Mae and Freddie Mac, why is Redfin and CoreLogic, why are they saying that prices aren't going to jump that much? And the reason that they're talking about that is because they think that mortgage rates are going to rise. Now, let's give them an example. All right. So let's say a borrower takes a $500,000 mortgage, okay, $500,000. So a borrower takes $500,000 mortgage at 3.1% as far as their mortgage rate, they'll see a $2,135 monthly payment. That's not factoring in taxes or insurance. All right. But if their rate is a 3.6 as projected by Redfin, then the payment would rise to $2,273. Okay. So that's nearly $50,000 over the 30 years. So if we take a $500,000 loan and we go from a mortgage rate of 1.3 to a mortgage rate, not 1.3, 3.1% to 3.6%, that's only 0.5%. It's only 0.5%. Well, on a $500,000 mortgage over the course of 30 years, that's $50,000. That's $50,000. Okay. Let's move on with the article. Another unknown. All right. Will corporate America begin pushing harder next year to bring staffers back into the office? If the workplace is less work from home friendly next year, that could translate into fewer buyers in both second home markets like the Hamptons or some of the suburbs. That concern is shared by Franklin Martell, who's the CEO of CoreLogic, who wrote in the real estate data firm's latest forecast that as we head into 2022, we expect some moderation in current patterns of flight away from urban cores as the pandemic wanes. All right. So what he's saying is that as people buy, because right now people were buying second homes, people were buying second homes, people were moving closer to family and friends, and the reason is because they were allowed to work from home. Now, if corporate America says, all right, no, y'all got to come back into the office, which I don't personally see. I don't personally see that. But if they say, no, you got to come back to work, then people are going to more gravitate towards your cities where it's easier to get to work versus buying that second home where, hey, I can work here. I'm in Philadelphia, but I'm a real estate agent, so I can work anywhere. So I can work here or I can be on the beach working. Okay. But if I had a corporate 9 to 5 and they're saying, okay, you can work from home, then yeah, I can work here in Philadelphia or I can work by the beach. But if they're saying, yay, hey, you got to come back to work, then I got to stay in Philly. And now I'm probably not going to buy that house in the beach because I won't be spending much time there. Okay. All right. So let's continue. It says, but there is one outlook that is relatively bearish on price growth. All right. All right. So who's bearish on price growth? And these are people we probably should be looking at. Okay. The Mortgage Bankers Association. All right. The Mortgage Bankers Association, an industry trade group, is predicting that the median price of existing homes will decrease, not increase, but decrease by 2.5% between the fourth quarter of 2021 and the fourth quarter of 2022. When you look closely at its model, it's easy to see why. The Mortgage Banker Association is forecasting that the average 30-year fixed mortgage will hit 4% by the end of 2022. Again, a whopping 4% by the end of 2022. Over the course of 30 years, that's an additional $90,000 in cost to that $500,000 fixed rate mortgage, what we just talked about. Okay, so that $500,000 fixed rate mortgage, if you had a 3.1% and you went all the way to 4% over 30 years, that's an extra $90,000. Okay, so I'm saying all that and I'm putting emphasis on that so you guys just know, hey, the importance of interest rates and how even if they only move a little, you look at it and you say, oh, well, there's between 3.1% and 3.6%. It's still 3%. What's the problem? What's the dealio? But you'll see over time, that's over 30 years, it does make a big impact. It does make a big impact. Okay. All right. So last but not least, this article says even if the Mortgage Bankers Association price drop comes to fruition, it will hardly be a housing crash. In fact, in that scenario, U.S. home prices would still be up over 20% from pre-pandemic levels. All right. So what this article is saying is even if that happened, it wouldn't be a housing crash. Because if you take the pre-pandemic levels and you go to, if it went up to 4%, then you would still be up over 20%. Okay. So let's bring it all home. Who cares about what's going to happen in the real estate market for 2022? Who cares? I'll tell you who cares. People who are buying short term. People who are buying for the next flippers. Are you a flipper? If you're a first-time home buyer, you're not a flipper. If you're a buy and hold investor, you're not a flipper. Why don't the first-time home buyer, or why doesn't the buy and hold investor, why shouldn't they care what's going to happen in 2022? The reason why they should not care is because they're in it for the long term. They're in it for the long term. So as long as they keep, and I tell people this all the time, and if you've been here before, you've probably heard this over and over and over, is that if you buy a home right now and you plan to keep it for 20 years, I got a secret for you. But I need you to like this post. Before I give you this secret, I need you to like this post. Okay, here's a secret. Everything's on sale. Everything is on sale. If your outlook is 20, 25 years, 15, 20, 25 years, everything is on sale. If we go back 20 years, if we go back to 2001 right now, and you look at the home prices, home prices in 2021, in 2001, and you compare them to right now, everything is on sale. So that's why if you're a first-time home buyer, it doesn't matter. If you're a buy and hold investor, it doesn't matter what's going to happen in 2022. You buy a solid investment, you buy a solid home that you feel safe in, that is the right size, and the finishes, you can fix the finishes. You good. You good. So don't get into the emotional roller coaster of the up and down of the market. Okay? You shouldn't, because it depends on your strategy. If you're a first-time home buyer, if you're a first-time home buyer, it's an excellent time to buy. If you're a first-time home buyer, it's an excellent time to buy. If you are a buy and hold investor, it is an excellent time to buy. And also, if you're a flipper, it's an excellent time to buy, especially in the Philadelphia market. In the Philadelphia market, investors made on average 100% profit last year in Philadelphia. 100%. That was the third highest in the nation. The third highest in the nation was Philadelphia. Check the records, check the stats, baby. Anyway, all right, y'all. So almost a half an hour. All I want to do a half an hour here, giving y'all, pouring into y'all, giving y'all some good stuff. Again, it's Khalid Nathan Aleem. If you're looking to buy a home, sell a home, or invest in real estate, I got you. And that doesn't matter where you're at in the United States, but I'm licensed in Philadelphia or Pennsylvania. You know, Philadelphia and Pennsylvania, they say we're separate. All right, maybe not, but that's what we think. That's what Philadelphians think in our mind. All right, so Philadelphia, all of Pennsylvania, New Jersey, and Delaware. All right, y'all. Till next time, I'm out.